If you're a pensioner in the UK right now, there is a real date on the calendar that is going to change how much tax you or your family pay. It's not a rumor, it's not clickbait, and it's not something you can opt out of by ignoring it. It's the 6th of April, 2027. From that date, most unused pension funds and death benefits in this country will be pulled into your estate for inheritance tax for the first time in the history of the modern pension system. That's confirmed. It's in the Finance Act 2026, which received royal assent in March this year. It is not a proposal anymore, it is law. But that's only one of several changes converging on retirees at the same time, and most of them are quiet. They don't arrive as a letter through your door explaining what's happening. They arrive as a slightly smaller net income, a tax return you've never had to fill in before, or a pension pot that suddenly counts differently when you die. Today I want to walk through exactly what's changing, exactly which numbers matter, and exactly what you can do about each one using nothing but the actual rules Revenue and Customs and the Department for Work and Pensions have published. No guesswork, no horror stories, just the mechanics so you can see them clearly enough to act. Let's start with the one almost nobody talks about because it doesn't feel like a policy change. It feels like nothing happening at all. And that's exactly the point. The frozen personal allowance. Your personal allowance is the amount of income you can receive each year before you pay any income tax. It currently sits at $12,570. It has been frozen at that exact figure since April 2021, and it is set to stay frozen for years to come. Normally, that allowance would rise a little each year in line with inflation. It hasn't, and because it hasn't, something is happening in the background that catches an enormous number of pensioners off guard. The full new state pension, boosted every year by the triple lock, is now worth £12,54760 a year. Sit with that for a second. The gap between your entire state pension and the point where you start owing income tax is now about £22. £22. A few years ago, that gap was closer to £3,000. It has shrunk almost to nothing, and it's shrinking further every single time the triple lock pushes the pension up while the personal allowance stays exactly where it is. This is called fiscal drag. Nobody voted for a pension tax rise. No chancellor stood up and announced we are now taxing the state pension, but the mechanics do it anyway silently because one number moves and the other doesn't. If you have even a small private pension, a modest annuity, or interest on your savings on top of the state pension, you are very likely already over the personal allowance line or about to cross it. And once the state pension alone exceeds £12,570, which independent forecasters expect within the next couple of tax years, if the triple lock continues as planned, pensioners with no other income at all will owe tax for the first time in the history of the state pension. The state pension is also paid completely gross. No tax is deducted before it lands in your account, unlike a wage underpay. So HMRC has to claw the tax back another way, usually by adjusting the tax code on any private pension you have or by asking you to complete a self-assessment return. If you've never filled one in before, that request alone can feel alarming. It isn't a mistake. It's the system working exactly as frozen thresholds and a rising pension were always going to make it work. What can you actually do about this one? Not stop it. The freeze is government policy, not something you can negotiate around, but you can make sure you're using every allowance available to reduce the income that gets counted against that shrinking threshold. If you're married or in a civil partnership and one of you earns below the personal allowance while the other is a basic rate taxpayer, look at the marriage allowance. It lets the lower earner transfer up to £1,260 of their unused personal allowance to their partner, which can save the couple up to £252 a year. It's a 5-minute application on the Gov.uk website. It can be backdated up to 4 tax years, and an enormous number of eligible couples simply never apply for it because nobody tells them it exists. Your savings and the personal savings allowance. The next area where retirees quietly lose money is savings interest, and it's tangled up with the personal allowance freeze in a way that catches people out. Basic rate taxpayers get a personal savings allowance of £1,000 a year in interest before any tax is due. Higher rate taxpayers get £500. But here's the trap. If your total income, including your state pension and any other pension income, is already close to or over the personal allowance, every pound of savings interest on top of that is stacking directly against your remaining tax-free space. With interest rates on cash savings still meaningfully higher than they were a few years ago, pensioners who kept say $30,000 or $40,000 in an easy access savings account are now generating enough interest to tip themselves into paying tax who never would have a few years back. The fix here isn't complicated. It's just underused. Every adult in the UK has an ISA allowance of £20,000 a year, and interest, dividends, and gains inside an ISA are completely tax-free forever with nothing to declare on a tax return. If you're holding meaningful cash outside an ISA purely out of habit, Moving it into a cash ISA at the start of each tax year or spreading a transfer across a couple of tax years to stay under the £20,000 annual limit takes that interest permanently out of the income that HMRC counts against your personal allowance and your savings allowance. It costs nothing to do, it just requires you to actually do it. And April the 6th, the start of the new tax year, is when that allowance resets. So any unused ISA allowance from this tax year disappears the moment the new one begins. Dividends and capital gains, the allowances that keep shrinking. If you hold shares or investment funds outside of an ISA or pension directly or through an old share dealing account, an inherited portfolio, or investments built up before ISAs became as generous as they are now, two more allowances matter, and both of them have been cut hard in recent years. The dividend allowance, the amount of dividend income you can receive tax-free each year, now stands at just £500. It used to be £2,000, then £1,000, and it's been reduced twice since. Once you're above that £500, dividends are taxed at 8.75% for basic rate taxpayers and higher for higher and additional rate taxpayers layered on top of whatever tax band your other income already puts you in. The capital gains tax annual exempt amount, the profit you can make on selling shares, funds, or other chargeable assets before CGT applies, is now £3,000. That's also down sharply from £12,300 just a few years ago. If you're sitting on shares you've held for years with substantial paper gains and you sell more than £3,000 worth of profit in a single tax year outside an ISA, the excess is taxed at 18% or 24% depending on your income tax band. The practical response again comes back to the ISA. Moving investments from a general account into an ISA is called BED and ISA. You sell the investment, use that tax year's ISA allowance to buy it straight back inside the ISA wrapper, and from that point on, all future dividends and gains on it are shielded completely. You may trigger some capital gains tax on the sale itself if your gain that year is above £3,000, but every year you can move another chunk under your IA allowance. So for anyone holding a large portfolio outside a wrapper, spreading this over several tax years before allowances shrink further or before the assets grow further is worth genuinely sitting down and planning rather than leaving to chance. The state pension and provisional income. No, the UK doesn't have this trap, but check this instead. Some of you may have seen American content warning about a provisional income formula that taxes Social Security. The UK doesn't work that way. Your state pension isn't taxed differently based on other income thresholds like that. But there is a UK-specific version of the same underlying problem because your state pension is treated as taxable income and stacks on top of everything else you receive. A private pension, part-time work, rental income, or investment income can each individually push your total income over the personal allowance and into the 20% basic rate band. Even though none of those income sources looks large on its own, this is where thinking about the order you draw money from matters. Income from an ISA is entirely tax-free and doesn't count towards your personal allowance calculation at all. If you're choosing between drawing extra income from a taxable pension pot versus dipping into IA savings to cover the same expense, the IA withdrawal is the one that doesn't push you closer to or over the personal allowance line. Pension credit, the one that's the opposite of a trap. Not everything here is a threat. There's one entitlement that works entirely in the pensioner's favor and it remains dramatically underclaimed. Pension credit tops up the income of the lowest income pensioners, and unlike most benefits, it acts as a gateway. Qualifying for even a small amount of pension credit can unlock housing benefit, a council tax reduction, a free TV license if you're over 75, and help with NHS dental costs and glasses. And yet, an estimated 880,000 eligible households in the UK are still not claiming it. If your income is modest, checking your eligibility on Gov.uk takes a few minutes and could be worth thousands of pounds a year in combined support. This is the one part of the system where the silence costs the government money, not you. So, it's worth breaking that silence yourself. Now, the big one. Pensions and inheritance tax from April 2027. This is the change with the largest numbers attached to it, and it's the one with a genuine legislated government-confirmed deadline. Right now, in the 2026-27 tax year, most unused pension funds, the money still sitting in your defined contribution pension when you die, sit outside your estate for inheritance tax purposes. Pension schemes have discretion over who receives that money, and because of that discretion, it is generally not counted as part of what you leave behind for IHT calculations. This is precisely why pensions have become such a popular tool for passing wealth down the generations. Draw your income from other savings and investments first. Leave the pension untouched and it passes on largely outside the inheritance tax net. From the 6th of April 2027, that changes. Most unused pension funds and pension death benefits will be brought into the value of your estate for inheritance tax purposes. This was first announced at the autumn budget in 2024. went through a full technical consultation and became law with royal assent in March 2026. It is confirmed, it is dated, and it applies to deaths on or after the 6th of April 2027. If you die before that date, the current rules still apply even if the pension is paid out to your beneficiaries afterwards. The line that matters is the date of death, not the date the money moves. There are exemptions. Death in service benefits paid from a registered pension scheme remain completely outside inheritance tax under the new rules, and the existing spousal exemption still applies. If your pension passes to a surviving spouse or civil partner who is a long-term UK resident or to a registered charity, that transfer remains free of inheritance tax just as it is now. From April 2027, personal representatives, the executives handling your estate, become responsible for reporting and paying any inheritance tax due on unused pension funds, working alongside the pension scheme administrators who will share the necessary information under new rules HMRC has published. If tax is expected to be due, administrators can be directed to withhold up to 50% of the taxable pension benefits for up to 15 months from the date of death while that tax gets settled with HMRC before releasing the remainder to beneficiaries. That's a real practical delay families should know is coming, not a scare figure. It's written into the government's own policy paper. The government's own estimate is that around 213,000 estates hold inheritable pension wealth in the 2027-28 tax year, and of those, roughly 10,500 estates, about 1.5% of all UK deaths, will become newly liable for inheritance tax because of this change where they wouldn't have been under the old rules. Most estates will still owe nothing. The standard nil rate band remains £325,000, and the residence nil rate band, which can add up to £175,000 more if you're passing a home to direct descendants, is unchanged, too, both frozen until at least 2030. But if your total estate, including your pension pot, sits near or above those combined thresholds, potentially £500,000 for an individual or up to £1 million for a married couple using both nil rate bands and both residence bands, this is a genuine reason to get your figures added up properly before the rules change, not after. The practical step here isn't to panic withdraw your pension. Emptying a pension pot early to dodge future IHT usually creates a much bigger, more immediate income tax bill right now. Since large pension, the right first step is simply arithmetic. Add up your pension pot, your property, your savings and your investments. Compare the total against your available nil rate bands and see whether you're actually likely to be affected at all. If you are, this is exactly the kind of situation where speaking to a regulated financial advisor or an estate planning solicitor before April 2027 is worth the fee, because the options adjusting how and when you draw your pension, reviewing your will, considering gifting strategies within the existing 7-year rule, or restructuring how assets are held between spouses genuinely depend on your specific numbers, not a generic formula. Bringing it together, none of these changes exist in isolation. A frozen personal allowance means more of your state pension counts as taxable income. That taxable income total is exactly what determines whether your savings interest, your dividends, or your capital gains tip over their own shrinking allowances. And the inheritance tax change from April 2027 means the pension you might have planned to leave untouched, specifically because it sat outside your estate, will very shortly not sit outside your estate at all. The through line across every single one of these is the same. Nothing here requires an emergency reaction, but everything here rewards knowing your numbers early rather than late. Check whether you and your spouse are both using the marriage allowance. Check whether meaningful cash or shares are still sitting outside an ISA when £20,000 of tax-free wrapper allowance resets every April 6th, whether you use it or not. Check whether you or a parent might be eligible for pension credit and simply haven't claimed it. And if you or your family have a defined contribution pension of real size, sit down before April 2027 and work out in actual figures whether the new inheritance tax rules are going to touch your estate. None of this needs a subscription, a paid guide, or a personal email to me to work out. Every figure I've given you today comes straight from Gov. UK and HMRC's own published policy papers, and you can look each one up yourself in a few minutes. The state pension and personal allowance figures are on your annual state pension forecast at Gov. UK. The pensions inheritance tax technical note is published in full on Gov. UK under inheritance tax on pensions. The ISA, dividend, and capital gains allowances are all listed in HMRC's rates and allowances tables for the current tax year. If this helped make sense of what's actually changing rather than what headlines make it sound like is changing, that's the whole point of this channel. I'm going to keep working through these DWP and HMRC changes as they're confirmed. So, if you want the plain English version before the deadline arrives rather than after, stick around. I'm Retired UK. Thanks for watching.